There are three major reasons that you should pay attention to why American and European stock markets are still not out of the woods, and you should position your portfolio with respect to the risk. The first reason is that the stock markets tend to historically fall when the Fed eases its interest rates. To prove my claim, let me share a chart with you that I have put myself together. It's not very neat, but it will do the job. On the top part you can see the chart, where the blue line represents Fed funds rate, red line US unemployment, spanning as far as 1955. And on the bottom part there's a chart of S&P 500. The interesting thing about this chart is that it shows how the stock markets tended to behave with respect to the Fed funds rate. On the upper chart, notice those green vertical lines. These show the moments when the Fed finally decided to pivot and lower the interest rates. As you can see, those moments are usually followed by the recessions. But it's actually not that the recessions are caused by the Fed. It's that the Fed lowers the interest rates when it sees the recession coming. The most reliable sign that the recession is on its way is that the unemployment is about to skyrocket. This is also showcased by the chart, where whenever there was a recession, the unemployment grew parabolically. But as you may know, the labor market in the United States is still resilient and the unemployment rate extremely low. This leads many investors to believe that we will achieve a soft landing this time. But according to my chart, it may be still too early to say that we will have the soft landing in the United States. That is because the unemployment usually grew when the Fed stopped increasing its interest rates for quite some time. What many people may not know is that the soft landing mentality is quite prevalent in the middle stages of the monetary cycle. That is evidenced by the fact that historically stock markets tended to rally while the interest rates were growing. That happened prior to 2019, before the Great Financial Crisis, and in many other instances. In conclusion, this chart implies that the stock markets could continue to climb up until the first signs of fundamental economic slowdown emerge. It also tells us that we are not nearing the end of the monetary cycle, we're rather somewhere in the middle. The Fed has yet to pause its interest rate hikes, after which they will keep the interest rates stable, which takes usually between 4 to 8 months. The second reason that warrants a cautiousness is the famous yield curve. It is one of the biggest bear arguments currently, and that is because since 1980, every recession in the United States was preceded by the yield curve inversion. The most popular version of the yield curve that is used for predicting recessions is the spread between 10-year and 2-year Treasury yield. This chart shows that every single recession in fact was preceded by the yield curve inversion, i.e. the curve going into negative territory. But not every yield curve inversion was followed by the recession, as it was for instance in the year 1998. The reason why the yield curve was able to predict recessions in the past is based on the wisdom of the bond market. The bond market accounts to approximately $120 trillion, where a stock market is smaller and accounts to approximately $110 trillion. The bond market is usually better at predicting the macroeconomic situations and the political consequences, whereas the stock markets are mostly concerned with the profits of the companies and are not that good at predicting the macroeconomics. Currently, the yield curve is the most inverted since 1980s, and that decreases the probability that recession is around the corner. But the yield curve is actually more efficient at answering the binary question of whether the recession will happen or not, rather than to time it precisely. Therefore, there's no way of telling how long the inversion will continue or when the recession will come. However, there's one way you can tell that the recession is very near, and that is when the curve reinverts above the zero line. It is the reinversion phase that is most painful to the markets, as the interest rate cuts are being priced in, and moreover, the reinversion phase was historically very strongly correlated with the rising unemployment. Therefore, it is historically the reinversion phase when the stock markets tended to trough, not the inversion phase when the curve was falling down. Actually, when the curve was falling down into the negative territory, the markets usually rallied. Currently, it seems that the yield curve is still falling deeper into the inversion, and this is also proved by the markets rallying. However, beware, because the reinversion phase is unavoidable, and that is when the stock markets may feel some pain. And the final reason why investors should be aware is that this time is truly different. First, the enormous amount of money that was printed during the pandemic effectively delayed the effects of growing interest rates. And that is because both businesses and consumers had enough time to stock themselves with the excessive amounts of cash. Now, these savings are mostly being depleted, however, they still represent some kind of cushion. And secondly, this cycle was touted as the most expected cycle in the history. That means that both consumers and businesses had plenty of time to prepare for the environment of more expensive debt, which again delays or even counters partially the effects of interest rates. And the third reason why the interest rates may not flow through the economy as expected is because of the growing proportion of the services sector as compared to the manufacturing sector. It is the manufacturing sector that is more sensitive to the interest rate hikes than the services sector. That is because the businesses and services sector rely less on the debt than the manufacturing sector. All these factors combined lead to one conclusion, and that is that the effects of the interest rates this time will be delayed. All in all, it does seem to me that it is still too early to declare a definitive bull market while we're still in the middle of the cycle. Many investors now feel optimistic about the future of US economy, but it may be that this is just a recurring behavior that is typical to this phase of the monetary cycle, which is that calming period before the interest rates actually hit the economy. The stock markets may continue to rally for some time. However, be careful about going all in this rally.